folks, and welcome to the Daily Coin. My name is Rory, and I have on the line Mr. Eric Dubin, who is the managing editor over at thenewsdoctors.com. How you doing, Eric?
I'm doing great. It's nice to be back.
Well, I'm really glad that you're here. We have a lot to cover, so let's just jump right in. What do you say?
Sounds good.
I popped over to Zero Hedge to see what was going on, and the White House goes full J.P. Morgan, unleashes hashtag Ask the White House on Twitter. I don't know if you've seen that or not.
No, that must be a new post. That doesn't surprise me at all, though, because they basically take it to Twitter and Facebook with all these asinine type of public relations stunts to, facilitate their foreign policy and whatnot. The spokesperson for the State Department, that blonde, I forget her name, but she stands before the camera with all of these "I am Ukrainian," and all these other strange hashtags like "Don't forget X, Y, and Z" or whatever. And as if that's like, the superpower of the world coming to, distribute its messages upon the masses. It's actually kind of pathetic when you think about it.
It's sad.
Par for the course.
I mean, it's a clown show. I mean, I can only imagine. If you go and look at it right now, this Twitter feed, because they've got the feed on Zero Hedge. And there is and Bonsai's doing his thing, William Bonsai, which is awesome. I mean, he's
yeah, I love this stuff.
I do too. I mean, he's great. But there's somebody from the State Department. They've got photographs of all these people that are sitting around this table with their laptops, and they're tweeting and blah blah blah. And there's one of the members from the State Department who is sitting there with a cheesehead hat on, with a cheesehead necktie. And this is going out to the world.
And what the heck is the message?
I mean, it's like, is it any wonder that people make fun of us from around the world? That how could anybody take the government of this country seriously? It's a joke. It's beyond pathetic. I mean, it's just sad. Oh my goodness.
On a more serious note, I mean, they actually, instead of just making fun of the State of the Union and all this feedback stuff, when on serious foreign policy issues, they literally resorted to using Twitter with dumb messaging to try to make it as if it's something productive. Like when the kidnappings were going on in Africa, in Nigeria.
Yes.
And Michelle Obama would say, "Bring back our girls," with this like stoic look, holding up this hashtag on a placard so that people could see it in the image. I mean, come on, this is like considered an integral part of their communication strategy, and I mean, it's a sign of how bad things have devolved to the point where the masses in our country are just kind of completely dumbed down to the point where this is considered to be something productive.
Yeah, 140 characters, including spaces and punctuation.
Yeah, right.
I mean, are you serious?
Here's your diplomatic protocol. You got 140 characters to send out your message. Frankly, there's more important stuff to do in the 48 hours following the State of the Union, but it's all just a packaged public relations show, and it's bipartisan at that. I mean, the Republican speech afterwards was very formulaic. You can literally go back to Republican rebuttal speeches for the last 30 years and see the same formula that they use in terms of what are the talking points and the subjects to address.
Speaking of which, I do want to ask you about the chart of the day, the Impossible is Possible edition. And this is over at Zero Hedge that you sent me that link to.
Right.
And I was looking at it. Bonds are debt instruments that governments they issue in order to generate income.
The far more important part is that the sale of the bond creates an immediate inflow into the Treasury. So it's a fund of the government.
Yes.
Because the private sector and international actors, be they countries or whatever companies doing trade, you're storing their money in shorter term, typically, debt instruments. And in our big fiat system that we have, where pretty much everything around the world is based on fiat, and the system being predicated on debt, that literally debt becomes the monetary currency. We don't really have money, and that's something that most people don't quite get, and they don't wrap their heads around.
Right.
We have credit, and this chart that I sent over is the 1-year Swiss bond yield.
Yep.
And for the majority of the period of time, there's a lot of volatility and whatnot, but it sticks around pretty much 0% until roughly around September of last year, and then starts drifting downward into negative rates. And then it goes through a really punctuated move, accelerating to the negative in December, which got down to just eyeballing it roughly about negative 0.5%.
Yep.
And then spikes back up towards the close of the year, kind of probably partly portfolio positioning and closing of books and things like that, partly drove that move. But then as we get closer and closer to the announcement that we saw last week, where the Swiss National Bank said we're going to depeg, and they also talked about formally increase or moving further to the negative by 75 basis points, their formal policy for their yields. And what this shows is that people are so freaked out about the state of the monetary system worldwide that when it comes to the store of value function of quote-unquote money, or better said, this currency monster that we have in our credit system, that these debt instruments serving as quote-unquote money, they're willing to hold something that will have them lose 1% for a 1-year period. Most people don't hold bonds for that long when it comes to the hot money. And overall, just to paint a picture of how much money is sloshing around, we have a forex market, an international currency trading market that exceeds $5.3 trillion worth of notional value in daily trading back and forth. So, the liquidity that flows around and is just monumental, and that's, a little bit more than 1/3 of the gross domestic product of the United States output on a yearly basis, just to put that in perspective.
That is a lot of money.
So, what this chart shows you is that there's only so many parking spots that these uber wealthy people can use to store their wealth on a short-term basis, and what you see in that spike down in the 1-year Swiss bond yield is partly the reflection of a lot of people just shifting their monies around.
That spike down, does that represents what someone decided, or is that decided by the market, by the inflow of money, or did the policymakers say we're just going to shoot it down?
It's not so much that the policymakers are shooting it down, it's just that they're announcing that their intentions to peg, usually on the shorter end, interest rates at a negative rate sets the tone for the overall bond market vis-a-vis other bond markets. And then you have the expectations I talked about, where people are perceiving the Swiss franc as being a better parking spot versus anything related to bonds denominated in the euro, for example.
Okay.
And people also now, most likely incorrectly, believe that the Fed is going to begin to start raising interest rates as early as June. And there's a huge percentage of the conventional finance community that really buys this story. I mean, I think it's possible that they might be able to squeeze in a 25 basis point hike, but the realities of the deflationary acceleration that we can see all over the place, and that's partly related to what we just talked about with the Swiss bond diving, and the derivatives systemic risk that can be set off like an imploding daisy chain of dominoes related to the oil sector debt and the debt that corporations in developing countries, as well as to some extent even sovereign bond issuances, where they've issued a boatload of bonds, something like $9 trillion, if I remember correctly, what Jim Rickards had estimated, in dollar-denominated debt, is now on the precipice of possible defaults for a reasonably large percentage of that. I mean, just a 10% percentage $9 trillion pile, $900 billion. And as the dollar has risen, the expectations for the dollar's rise was nowhere near as much as it in fact rose over the last 6 months. So a lot of these positions that these bondholders have turned upside down. They don't have the cash flow to cover them. So you're going to see a lot more defaults. And I think that the timing for what went on in the oil sector will probably start to show some of the dead bodies as early as March, maybe April, tied to the quarterly reporting period. They can hide stuff pretty well for the time being. All that is going to start hitting the tape, so to speak. And when it does, and when the economies continue to spiral downward, as we can see with this deflationary wave kind of pouring over the world, there's really going to be a difficult case for the Fed to make that, we're going to start tightening. And I think that whole propaganda meme that they're trying to support is going to go out the window.
I would agree. It's that there's no way that they're going to raise interest rates this year. That ain't going to happen. I don't think they ever will.
There's one scenario where they could actually pull it off, and that's not probably as likely now that we know what the ECB is probably going to do tomorrow, because they leaked the information, and we'll get to that in a minute.
Yeah.
But if the ECB had in fact come out with like $1 trillion or €1 trillion quantitative easing, that is a heck of a lot of liquidity coming out of the fire hoses of Europe, and it could in fact have supported the whole system. The fact that they only did the fact that they have leaked the executive board's intention to do what is reported to be 600 billion euros, about 50 billion per month for at least a year, suggests to me that the time frame that I initially was thinking of, the March through beginning, say, September, that the end of March, second quarter start through the start of the third quarter being a window where the shit is going to start hitting the fan, and we're going to see an end to all of this talk about the Fed wanting to do the sober thing of taking away the punch bowl. More and more people, even in the regular finance community, the Keynesians and the typical Wall Street portfolio managers and whatnot, are beginning to just kind of like look around and think, gee, things are getting a little loopy here. Yeah. And that's a sign that we're getting much further along in this end game process.
Do you think that that with the Swiss depegging last week, that the central banks are losing credibility? And more importantly, do you think that, you remember back in 2008, 2009, when there was a credit freeze because the banks didn't trust each other?
Right.
Do you see that happening now at the central bank level with what happened with the Swiss?
They're kind of playing a game of poker where they're putting a public face and bluffing, but in reality, the whole movement to repatriate gold, the decision by the Swiss to basically flip the bird to the ECB and say, forget it, we're going to take back our monetary sovereignty. Those are all examples of central bankers looking around and trying to protect, to some extent, their own position relative to the rest of the world. I mean, the reality is that there is a level of coordination that goes on, particularly among the Western central bankers, in terms of this end game. I mean, these guys have gamed out various scenarios to how to deal with what even they understand is an untenable level of debt, and that somehow, some way, we have to have some kind of a reconciliation. And their pipe dream was, for the better part of the last 7 some odd years, to think that financial repression with artificially lower rates would stimulate economic activity to the point where tax revenues would go up, and then simultaneous other dynamics making it such that it would stimulate the desire among investors to go out and speculate further, to push up asset prices that would in turn help restore the broken balance sheets of banks. And all of that is not working anymore. It worked actually for a short period of time between March 2009, when we bottomed, and say about roughly the end of QE2, where the housing market had a gigantic dead cat bounce. The stock markets did reasonably well, but more importantly, banks had some repair in their balance sheets, in large part actually just because the Federal Reserve was taking down garbage debt that was valued anywhere from 80 cents on a dollar all the way down to maybe even 20 cents on a dollar, and then booking it on their balance sheet at $1 worth par of whatever the original issuance of the junk of the bonds that became junk were issued in the market, all the mortgage-backed securities and so forth. So the game that they ran worked for a period of time, but now it's changing. And what we saw beginning, probably you can peg the time frame at like April of last year, when deflationary fears began to start seeping into the market more aggressively. That's when that bounce that we had in the bond market turned around and yields started falling again and kept on falling. And then the oil market rolled over in the June, July period, just, subtly at first, but then, accelerating like crazy once the ball started getting rolling, and the yahoos in our foreign policy establishment decided to make war on oil and the ruble and all that other stuff. So the bottom line is that I think that the deflationary wave is actually getting out of their control.
Yes.
And they're nervous about it. And the reporting that we're going to see coming out of Davos in the next few days is going to focus all on that. I mean, they're just going to be, deflationary wave that is accelerating is something that we need to get in front of, and they're going to try to spin that 600 billion euro QE is going to be enough to stop it. But at the same time, just I believe it was only a couple of days ago, Japan was talking about no longer doing QE, and we have this whole song and dance that we just spoke about with the Fed saying, we're going to raise interest rates, and we stopped QE last year. So all of these hopes and prayers are substituting for policy. And meanwhile, the worldwide economy is just kind of slowly but more quickly in the future moving down this whole deflationary crash.
Is it happening? I mean, are we witnessing the beginning of a global collapse? I mean, I know that it actually started, in 2007, 2008, 2009 time frame. Yeah. But I mean, is the acceleration happening right in front of us?